In January 2026, 57 Saks Off Fifth stores went dark across America. A luxury discount empire worth billions simply vanished. How does a brand backed by Saks, Neiman Marcus, and Bergdorf Goodman fail so spectacularly? This wasn't just another retail bankruptcy. This was the death of an entire business model. For decades, shoppers believed in a simple equation: luxury brand plus discount equals smart shopping. Saks Off Fifth promised that equation. Designer handbags, premium apparel, and luxury cosmetics, all 30 to 70% off. It seemed foolproof, a dream for aspirational consumers, young adults, and budget-conscious shoppers alike. But beneath the surface, the foundation was crumbling. On January 14, 2026, Google searches for Saks Off Fifth spiked by 300%. Consumers weren't searching to shop. They were searching for answers. One word dominated: bankruptcy. Saks Global Holdings filed for Chapter 11 protection after missing a $100 million interest payment. Within 2 weeks, liquidation notices went out. 57 of 70 stores would close. The website would shut down. The dream of accessible luxury was over.
Saks Off Fifth tried to sell true luxury at discount prices, but the math didn't work. Off-price retail succeeds by buying cheap, moving inventory fast, and repeating. TJ Maxx and Ross mastered this over decades. They buy manufacturer overruns, canceled orders, and seasonal closeouts. Then they turn that inventory in weeks, not months. Saks Off Fifth couldn't do that. It had to source merchandise that maintained the Saks prestige. Luxury stores themselves were struggling to move inventory, so the outlet got leftovers: outdated items, unpopular sizes, and styles nobody wanted. The model was fundamentally flawed. High costs and slow inventory turnover made profitability impossible. Every dollar spent on operations was a dollar unavailable for discounts. The dream of discount luxury collided with harsh financial reality. Shoppers didn't know what Saks Off Fifth stood for. Was it luxury? Was it discount? The name implied prestige. The stores felt like outlet malls. Fixtures were basic, displays cluttered. Checkout was standard. Prices were lower than Saks Fifth Avenue, but often higher than TJ Maxx or Nordstrom Rack. Luxury shoppers didn't trust it. Discount shoppers didn't find value. There was no clear positioning. In retail, confusion kills. If customers don't understand your brand, they won't shop with you. Saks Off Fifth existed in retail purgatory.
Stores were located in premium malls, high-rent districts, expensive fixtures, spacious layouts. Corporate overhead was massive. Staffing and operations added further cost. TJ Maxx places stores strategically in lower-rent areas. Metal racks, fluorescent lighting, lean staffing. Their model is ruthless efficiency. Saks Off Fifth tried to maintain luxury aesthetics while competing on price. It failed. High costs meant higher prices. Higher prices meant fewer sales. Fewer sales meant stores couldn't cover rent. It became a death spiral disguised as luxury. Instead of fresh, desirable items, stores received leftovers. Merchandise that didn't sell at full price, styles that were last season, colors that nobody wanted, sizes that were unpopular. Walk into TJ Maxx and you might find a surprise designer find. Walk into Saks Off Fifth and you got predictable, uninspiring inventory. The thrill of the treasure hunt was gone. Customers noticed. They stopped coming. The experience felt stale. The brand promise failed.
After the Neiman Marcus acquisition, vendor relations deteriorated. Saks Global demanded a bigger share of sales proceeds. Luxury brands resisted. Some reduced shipments. Some stopped sending new collections entirely. Why risk sending top-tier products to a financially unstable retailer? The stores were left with what vendors didn't want to sell. This created a vicious cycle. Less inventory meant fewer shoppers. Fewer shoppers meant less revenue. Less revenue meant more vendor pressure.
Eventually, inventory became unmovable. Stores became graveyards of unsold goods. The website was clunky. Inventory didn't match what was in stores. The treasure hunt experience failed online. Surprise finds don't work when everything is searchable. Competitors integrated online and offline seamlessly. Nordstrom Rack lets you buy online, return in-store, check inventory in real time. Saks Off Fifth offered none of that. Private equity invested $200 million, but returns never materialized. Customers avoided the platform. The digital experiment failed completely. COVID changed consumer behavior. Luxury sales briefly surged during stimulus periods. By 2023, inflation and rising interest rates hit budgets. Gen Z and millennials prioritized experiences, travel, dining, concerts. Off-price shoppers became more informed. They knew better deals existed at TJ Maxx or resale platforms. Saks Off Fifth didn't adapt. They sold a product that consumers could find cheaper elsewhere. The market evolved, the brand did not. Consumer behavior permanently shifted.
The Neiman Marcus acquisition cost $2.7 billion. Saks Global took on $2.2 billion in debt. Margins in retail are thin. Any sales drop threatened survival. Within weeks, cracks appeared. The company missed a $100 million interest payment. Vendors cut shipments. Operational costs remained high. Debt amplified every problem. The financial structure was brittle. One misstep could and did trigger collapse. Leadership tried to combine luxury with discount efficiency. Half measures never work. Premium aesthetics, high prices, and leftover inventory satisfied no one. Operational inefficiency and flawed pricing doomed the stores. Competitors were ruthless. Saks Off Fifth was indecisive. They tried to have it both ways and failed completely. The strategy ignored reality. Execution failed at every level. Shoppers never returned consistently. Deals were mediocre. Inventory was unpredictable but not exciting. Experience was uninspired. TJ Maxx and Nordstrom Rack built real loyalty. Customers evangelized the brand. Saks Off Fifth had none. The moment better options appeared, shoppers left. The division existed in a loyalty vacuum. Without loyal customers, no brand survives. The collapse of Saks Off Fifth is a cautionary tale. Brand names don't guarantee survival. Saks Fifth Avenue is iconic. Neiman Marcus has over a century of heritage. Bergdorf Goodman is legendary. But strategy, debt, and execution matter more than legacy. Even iconic brands can fail. Execution matters more than prestige. Value matters more than recognition. Customer loyalty matters more than brand equity. Financial discipline matters more than ambition. Saks Global tried to build a luxury empire through acquisition and debt. They failed. 57 stores closed. Empty buildings now stand as monuments to strategic failure. In retail, the most famous name is worthless without value, profitability, and loyalty. If you can't deliver those, you're just expensive real estate waiting to go dark.